For most of us, chocolate is just a simple pleasure, right? It's that treat you grab after a really long day. But what if I told you that some of the world's smartest investors see that same chocolate bar as a powerful signal for the entire economy? Well, in this explainer, we're going to peel back the wrapper and look at the fascinating financial world that's hiding inside.
Now that is a bold statement. It's basically saying that while tons of people are getting distracted by the wild swings of Bitcoin, the quote-unquote smart money is making a very calculated bet on something way more tangible, the future of our food. So let's unpack what that really means and why something as simple as cocoa could be a huge sign of major economic shifts on the horizon.
So here's what we've got on deck. We're going to start by uncovering the secret hidden deep inside chocolate, and then we'll get into the big picture, this whole devaluing dollar situation. We'll break down the absolutely crucial difference between a raw commodity and a company, check out a genius move by none other than Warren Buffett, and then finally we'll give you an inflation toolkit, all of which leads up to our final idea, the 2026 KitKat Index.
Okay, so what is this big secret? Well, it's that a simple candy bar, believe it or not, acts kind of like a sensor for the economy. It's picking up signals from all over the place. Think about it. The supply chain for cocoa tells us everything about global farming and logistics. The choices that huge companies like Hershey make, well, that reveals their strategies for staying profitable. And your own behavior, what you decide to buy when prices are going up, that's a direct signal of how inflation is hitting all of us. When you put all those data points together, they tell a really powerful story about the invisible forces shaping our world.
Now, to really get this whole chocolate arbitrage idea, we first have to understand the environment we're in. And that story, you guessed it, starts with the value of the money in our pockets.
For years now, central banks have been doing this thing called quantitative easing, or QE. Now, put really simply, they've been pumping trillions, and I mean trillions, of newly created dollars into the financial system to try and juice the economy. But here's the catch, and it's a big one. They increased the quantity of money, but they didn't increase the amount of actual stuff that money can buy. And that imbalance? It always has consequences.
And this brings us right to a classic textbook definition of inflation. When you have this flood of new money pouring into the system, but the amount of stuff to buy, cars, houses, and chocolate, stays about the same, the price of all that stuff just naturally goes up. Your dollar just doesn't stretch as far as it did before.
So, what do smart investors do when the cash sitting in their bank account is literally losing value every single day? Well, they don't hold on to it. They trade it for tangible assets, things you can actually physically touch. They move into gold, real estate, and yes, commodities like cocoa. They want to own the actual stuff, not just the paper that's being used to buy it, because that paper is depreciating.
Okay, now this is where most people really get it wrong. They hear something like cocoa prices are rising, and they immediately think, oh, I should buy stock in a chocolate company. But investing in the raw material and investing in the company that uses that raw material are two completely different games.
I mean, this slide just lays it out perfectly. On the left, you've got the raw commodity, cocoa beans. Its price is all about raw supply and demand. A bean is a bean is a bean. But on the right, you have a company with a super powerful brand, like See's Candy. They aren't just selling you chocolate, they're selling an experience. It's nostalgia, it's quality, it's the perfect gift. That brand, that's their massive, massive advantage.
And that advantage has a name, pricing power. Honestly, it's like the holy grail for a business when there's a lot of inflation. A strong brand like See's can just raise the price of its chocolate boxes to cover the rising cost of cocoa. And guess what? Its loyal customers will happily pay it. A cocoa farmer can't do that. They're what's called a price taker, not a price maker.
And the results? They're just staggering. I mean, look at this number, $31 million. That's all the additional capital Berkshire Hathaway needed to pump into See's Candy to grow its revenues by hundreds of millions. The real value wasn't in building more factories, it was in the brand itself, what Buffett loves to call economic goodwill. It's this invisible asset that produces very real and very, very incredible returns.
And speaking of Buffett, he once pulled off this absolutely genius trade that involved chocolate, and it perfectly explains this sophisticated concept called arbitrage. Okay, so let's walk through this step by step. Buffett found this chocolate company, Rockwood & Co., and he realized its stock was trading for less than the value of all the cocoa beans it had sitting in its inventory. So, step 1, he bought the company's stock. Step 2, he then redeemed that stock directly with the company for physical cocoa beans. And step 3, he turned around and sold those beans on the open market for a higher price. The result? A nearly risk-free profit, just by exploiting a temporary little price difference. Is brilliant.
So modern companies use a really clever version of this same logic. It's called premiumization. When the cost of their raw cocoa goes up, they might suddenly launch a new artisan dark chocolate with raspberry version at a way higher price. Or think about this real-world example. When Hershey announced it was shifting to natural colors, that wasn't just about health. No way. It was a brilliant move to protect their margins, letting them reformulate and reprice their products, shifting your focus away from the basic commodity to a premium experience.
Okay, so we've covered the theory. How can you actually apply these ideas? What kind of tools are out there to help you navigate a world of rising food prices? This is the crucial question, isn't it? If you're worried that your grocery bill is just going to keep climbing, how can you protect your own purchasing power? Well, one answer lies in the financial markets.
One of the oldest tools for this is something called a futures contract. Now, don't let the name intimidate you. It wasn't invented for Wall Street guys to speculate. It was actually created by farmers and bakers to solve a really simple, real-world problem: price uncertainty.
It works like this. Imagine a baker. She knows she needs to buy flour in 6 months, and she's worried the price is going to skyrocket. At the same time, you've got a flour producer who's worried the price is going to collapse before he can sell his harvest. So they can enter a futures contract, where they agree on a price today for flour that will be delivered in 6 months. And just like that, poof, the risk is gone for both of them. They've hedged. Now they can sleep at night and just focus on what they do best: making bagels and growing wheat.
Now, let's be honest, for most of us, trading futures contracts is pretty complex. A much easier way to invest in this trend is through something called an exchange-traded fund, or ETF. Just think of an ETF as a basket of assets that you can buy or sell with a single click, just like a stock. There are ETFs that track the price of gold, oil, or even a whole basket of agricultural stuff. It's a really simple way to get exposure to the rising price of stuff without all the complexity of the futures market.
And this brings us to our final concept, which kind of wraps everything we've talked about into one powerful idea. Let's call it the 2026 KitKat Index.
Take a look at this chart. As the price of raw cocoa, that's the purple slice, goes up, companies have to protect their profit margins. That's the green slice of the pie right there. Now, they could just raise the price of the whole bar, sure. Or they can do something a little more subtle. They can change the formula. They might shrink that purple cocoa slice and make the blue slice, the cheaper sugar and fillers, a lot bigger. This is a hidden kind of inflation, and you've probably heard of it: shrinkflation.
So the key takeaway here is that the KitKat Index isn't a real financial thing you can go out and buy. It's a mental model. It's a way for you to decode what's happening in your own shopping cart. The size of the candy bar might stay the same, but what's actually inside it could be telling a very, very different economic story about rising costs and corporate strategy. And that leads us to our final question. The next time you pick up a candy bar, just take a closer look. Are you paying for the commodity, the actual cocoa beans? Or are you paying for the brand, the marketing, and that company's protected profit margin? The answer tells you everything you need to know about where value truly lies in today's economy.